Hi everyone, welcome to this live coverage. As usual, I'm here with Yohay Elam from ForexCrunch and Mauricio Carrillo from FXStreet, and we are going to cover leave the Fed and the rate hike. Are we going to cover leave the rate hike? Yohay, what do you say?
Yeah, there's going to be a rate hike for sure. The big question is what's next?
Yeah, in the
so let's do this quick preview for those joining us. You're all welcome. The big question is what's after the hike, hawkish hike or dovish hike? So a bit of background. Initially, the Fed was in a sort of wait and see mode. We had a hawkish hike in December, talk about 3 hikes, but markets saw only 2 hikes. Then there was a disappointing wage growth figure in January, and Fed officials believed Trump's promises. That means they counted fiscal stimulus. So things cooled down. But 2 weeks ago, we had a coordinated chorus of Fed officials, including the Doves, including Brainard and Fisher and others such as Dudley, talking about a compelling case for raising rates, that the rates are too low, and Yellen finally gave us the final word. She said, barring any disaster, we're going to raise rates. And the NFP was good enough for raising rates. It's quite rare to see the Fed talking in one voice, and especially a hawkish one. So what matters most is what's next, in my opinion. And one thing that'll tell us a bit about what's next is the dot plot, this weird chart that tells us what the Fed expects for rate hikes. Okay, and there is also, of course, new forecast, press conference, and the statement. Okay, currently expectations are for 3 hikes in 2017, and the question is, will it change? Well, if we look at the Fed's mandates, it's optimistic. Jobs growth, it continues quite nicely, 200K per month. Inflation looks stable, 1.7. CPI, core CPI is 2.2, we learned today. And the Fed wants to be perhaps ahead of the curve, so raising rates very gradually before inflation heats up too much. But on the other hand, if we look at growth, and eventually employment and inflation are a result of growth, growth was only strong in Q3 2016, okay? Not so good. That was 3.5%. Q1, Q2, and also Q4 showed 1.5, 1.9 in Q4. And now the recent growth estimate, it's already too optimistic, because now the Atlanta Fed told us it's 0.9% in Q1. It's less optimistic. And Trump, as focuses on healthcare, not taxes or infrastructure. So these are sort of the two sides, weak growth, but good Fed mandates. So my baseline scenario, number 1, is a healthy hike. No change in the dot plot, everything very stable, a wait and see mode. Of course, they're raising the rates, and the Fed will tell us, well, we're still talking about 3 hikes, but markets, once again, like in December, will begin to doubt that. And my expectation is that we'll have a moderate sell the fact of the dollar. Anyway, not a big movement, okay? And second scenario, the dovish hike, if there is such a thing, is that they want to sneak in 1 hike now because stock markets are looking good, but then they're taking a long break. And they're stressing that there's uncertainty ahead, and perhaps even downgrading the dot plot to 2 hikes. In this case, it's clear to see a big dollar sell-off immediately, and then more sales ahead. This scenario has a lower probability. And the third scenario is a hawkish hike. High confidence by Yellen. Dot plot, in this case, maybe even rises to 4 hikes in 2017. That means now March, then June, September, and December. In this case, the dollar rallies hard for a few days, but I see this as having a low probability. The Fed is naturally dovish, and I think what we've seen 2 weeks ago was the exception, not the norm, of the Fed talking with such confidence and such hawkishness. So to conclude this quick preview, rate hike today is coming. I don't see it not coming. They told us that very clearly. The dot plot determines at least the immediate reaction, but of course, watch out for the statement, the forecasts, and Yellen's press conference. And my baseline scenario is that they'll probably keep things balanced, and we'll see a moderate sell the fact scenario. Anyway, not a big movement. Other scenarios are, of course, more extreme, more volatility, but I've learned to lower expectations from events, but hopefully we'll get more volatility. So that's it for this quick presentation. over to you, Valeria.
Yeah, I was thinking about what you said about buying the rumor, sell the fact. That was actually what happened over the past 2 Fridays, right? We have the first Friday with Yellen pretty much announcing this rate hike. And anyway, the dollar giving up ground. And the same happened this last Friday when the US released non-farm payrolls report, also good enough to support the rate hike, giving encouraging readings, even with wage higher, right? And even though the dollar also fell, so it's quite hard to predict where the currencies will go within a certain scenario. But I do believe that you described them pretty good, right?
Thank you.
Okay, thank you, Yohay, and thank you, Valeria, for starting. We just got a question about the gold. I know that it's pretty soon, but we are running on question now. So what is your
No
take
problem.
on gold? Yeah, go ahead, Valeria.
I don't know what the question is.
About gold. What is your take on gold?
What's my take on gold? Sorry, I was waiting you to make a question. Okay, well, I do believe that gold is trapped between the hard and the rock place because we have the Fed about to rise rates and trigger. So hopefully believe some dollar strength, and we know that gold is quite sensitive to any Fed move, right? If the Fed hikes, gold goes down. If the Fed cuts, gold goes up. That's one side of the scenario. The other side is the fact that there's a lot of political uncertainty surrounding not only the US with Donald Trump, but also Europe with elections. We are having Dutch elections today, right? And not sure when the outcome will be released. So it's like gold, it's there trying to figure out where it's the best choice, which one is the best choice, or what of these two sides will win the battle, either the Fed or the risk-averse environment. To be honest, I don't see it rising much. I do believe that the upward momentum will probably keep easing, at least for today. But of course, the 12th region has been a tough bone to break. In fact, the commodity has fell towards 1193 this past week. So that's the level I'm watching for bearish breakout. I do believe that below that level and with a firmer dollar across the board, we can go down to 1150. And on the other hand, I'm not seeing much of an upward potential at this point. I mean, of course, the pair can rise if the dollar plummets. The commodity, sorry, can rise if the dollar plummets. These highs around 1211 are my first bullish target. And above this last, I do believe that we can revisit these lows 1216 and not much more unless we have a huge surprise today, right? But overall, I believe that the dominant trend is bearish for today.
Thank you, Valeria. Yohay, you have any particular opinion on gold?
No, I think Valeria said it all. It looks to be falling, and I don't see this trend changing anytime soon.
Okay, so let's move to Australian dollar. There are a couple of questions from Facebook about the Australian dollar. What your take, if there is a sell or not, Valeria?
To be honest, no. Let me change the time frame. I'm moving to the one-day chart. I was watching that for most of the past February, the pair has been trading in between 76 and 77. I still see 77 as a huge resistance and a tough bone to break. I'm not seeing the pair actually clearly breaking and rallying beyond that level. But that range was lower, right, after a bearish breakout late last week. But 75 has been holding pretty nice, and now we are challenging back the 76 level, right? So I'm not sure if it's meaning it's not clear there is a selling here. In fact, the Aussie has been quite reluctant to dollar strength and remains so. I could not bet much on this one to downside unless we have I don't know, maybe a 50 basis point hike or something like that. But I'm watching right now short term 76.20 as being the immediate resistance, and I do believe that if we take that level, we will probably trigger stops and it will probably advance farther. Not much more, but up to 77. Of course, we are talking about normal movements. And for me, the immediate support sounds stands around 75.70 and 75.30, right? Those are the levels I'm watching towards downside. I do believe that the market will probably try to buy if somehow the pair falls back towards 75.
Okay, thank you. And Yohay, in your opinion, where is the Australian dollar? Yeah, rallying again, rallying.
Yeah,
fast.
I agree with Valeria. For me, it's one of the more stable currencies, if not one of the stronger ones. Australian economy is doing well. The RBA is in no mood to cut interest rates. There is a rebalancing and movement away from the mining sector. And we traded at a higher range between 76.10 to 77. Now we're a bit of a lower range. But if we have some kind of sell-off in the dollar, in the US dollar, I think the Australian dollar is one of the best currencies poised to recapture the previous range, get back to the top. So, yeah, I don't think. I mean, in case we're seeing a very hawkish hike, then I would sell. I would buy the US dollar against another currency, not the Aussie.
One word about the Aussie. We have February employment readings during the upcoming Asian session. So beware of that, because whatever happens with the Fed could be reverted later with the employment data.
Yeah, it's at midnight GMT, and recent employment reports were quite good in Australia, so that also supports the Aussie.
Okay, so move to the most trade pair in the world, euro dollar. There is a question from YouTube. That is, what will the rate hike do in the euro dollar, in your opinion, Valeria and Yohay?
Sorry, if there is a rate hike, what will be the reaction? That's what.
Yeah, what will be the reaction in the euro dollar?
Well, we all want to know what will be the reaction. Actually, we are not sure. As we were saying right now with Yohay, there's a good chance that despite the rate hike, the market will buy the rumor, sell the fact. We have been talking so long about this rate hike, meaning it was center stage for the past 3 weeks, right? That it's fully priced in. So things will not depend today on if we have a rate hike or not. Things will depend on what the Fed plans towards the future, right? If we are going to see a faster pace of hiking from now on, or if they say, okay, now that I hike, I will review back in December my next decision, right? That will be extremely negative, for example, for the greenback. So whatever happens, we will have to wait until Yellen speaks before taking a trading decision and finding out where the market is going.
Yeah. I'll add only that we have elections today in the Netherlands, not the biggest country in the Eurozone, but sometimes seen as a canary in the coal mine, as an indicator towards, for instance, in this case, the elections in France. I only know that the turnout has been very high, and voting ends at 8 GMT, so just after Yellen ends her press conference, more or less. So if we have a victory for the center-right party of Mark Rutte, the mainstream party, it'll be euro positive. If the number one party is the party of Geert Wilders, the Freedom Party, extreme right, it's bad news for the euro. So I think that for euro dollar, the reaction also might be a bit limited, unless we get a very, very extreme move from the Fed to the upside or to the downside in terms of their statement. Then I think markets will wait just a bit more before moving on euro dollar.
Thank you, Yohay. And let's take on dollar Japanese yen. What's your opinion on that, Valeria?
Well, the Japanese yen has been quite reluctant to give up to dollar strength. If you consider the pair's behavior, it has been unable to actually establish itself above 15 for over months already, right? I would say nearly 2 months that has been steadily rejected on attempts to regain the 15 level. And despite yields have continued to advance in the US, the pair has been stuck around this 1450 area, right? In fact, it's right now at fresh daily lows, but that's irrelevant. It's some position adjustment. But anyway, it has to take a big, super ultra hawkish Fed to push this one higher. My first resistance is the 15 area, of course, but I will be looking for a break above this 1550 high that we posted last week, right? To talk about a more constructive bullish outlook in the year. But by every other mean, the pair has more tendency to go towards the downside than towards the upside. And also, another word on this one is that the Bank of Japan will meet during the upcoming Asian session, also after the Fed and alongside with Australian employment reports. And well, we know that the central bank is largely expected to remain on hold. They are not going to cut rates. They are not going to change their buying program. You know, the bank is focused on maintaining control of the yield curve, and they are doing fine with that. So no much more expected from them. Of course, Governor Kuroda is always a bit more optimistic than what the reality says. But to be honest, inflation is nowhere near 2%. So talking about tapering in Japan is quite too early. Anyway, the bank can make some noise, particularly if they announce some sort of change in their policy. But I mentioned the resistance, and about the supports, we need to take 14, right? Break below 14 to see a bearish extension today after and with the Fed.
We have a question in Twitter. They're asking about the cable, about the sterling against the dollar, long or stay, or what do you think about this?
It's quite crazy behavior we had seen in here with the Brexit scenario and the Scottish referendum and the parliament and the polls and all of what's going on in the United States. But you know, if you draw a Fibonacci retracement for the latest January bullish rally, you will find out that the 61.8% of such rallies stands around 2060. And the recoveries we have seen earlier this week have sold right below that level. So as long as that level holds for me, the risk will remain towards downside, right? There's a lot of uncertainty and the market is building and unwinding positions in every headline coming from Brexit these days. So it sounds a bit risky, but I still see the pound as the weakest currency across the board, right? Today, employment figures the headline were great, but wage were terrible, right? If we consider the high inflation scenario, that the UK is living after the referendum, the Brexit referendum. So, and again, we have the Bank of England meeting tomorrow.
Yeah.
Pretty busy 24 hours ahead. Anyway, I mean, there's a lot of going on. I do believe the Bank of England can't ignore really what we are seeing, this decreasing wage in a rising inflation scenario. So the risk for the pound is really towards downside for me. Although, well, you know, we are waiting for the Fed. That will set the tone.
Yeah, Mark Carney at the Bank of England is stuck between a rock and a hard place. Brexit begins to bite. A weaker pound means that real wages are rising more slowly and inflation is rising. So does he want to raise rates and push sterling higher and move inflation lower? Or will this actually hurt the economy with all the uncertainty? So yeah, I also see the pound as a sort of weaker link. And we're still expecting to see Brexit announcement. We heard from the European Union that they want to start talks only in June, and time plays on the European Union side and against the UK. So I also see the pound as one of the weaker links. Currently, at least, we're seeing in recent days nice range trading between 121 and 122.50. And let's see if the Fed manages to break it. And tomorrow with the Bank of England.
Let's make a case on Brexit. Yohay, what's going on there right now about Brexit? What is the latest?
Latest is that the government managed to receive all the legal approvals from the House of Commons after it came back from the House of Lords. It was approved once again in the House of Commons and the House of Lords. Now it depends on the Queen, just a formality. And then the ball is in the court of Theresa May, the Prime Minister. The government is set to announce Brexit in the last week of March, after the EU's 60-year celebration from the Treaty of Rome of 1957, and then it's a 2-year countdown clock until there's something new. Best case scenario is that there will be some kind of a transitional agreement for 5 years, because we know that 2 years is a short time in terms of trade negotiations and divorce negotiations in general in this case. So a lot of uncertainty ahead. EU wants to start talks only in June, and that could play against the UK, against the British pound.
Yeah, I was thinking about that. Yeah, go ahead, Valeria.
No, I was thinking that I do believe that it's a personal view, right? But once Theresa May triggers the Brexit, don't you think things would be out of our control? Meaning, the ball will roll towards the European Union side of the field, right? The European Union will have the final word and say, no, we are not giving you this. No, we are not giving you that. I don't care what you want. I'm going to do this. You have to do that, and so on. So actually, the risk towards the pound depends not more on the UK government, but now on the Euro area parliament, right?
Exactly. Theresa May only has the authority at this point to trigger Article 50 to decide when to start the countdown clock. And I don't think it'll be a big surprise. It's going to be either March 27th, March 31st, maybe March 23rd. I don't know. I don't think it really matters. So yeah, then the negotiations will matter, and the European Union is just bigger than the UK.
Yeah, and now that we are talking about the European Union and the United Kingdom, what about the euro pound? What is your take, Valeria, on the euro pound? That we got a question there.
Well, we are having US news today, so actually I'm not expecting much for that particular pair, because I do expect both currencies to move more or less even against the greenback. So we are not going to see much volatility, I believe, within the euro pound. Volatility there comes when we have news either coming from the euro area or the United Kingdom. We are steady around 87. I do have a strong resistance area around 87.30, 87.40. So that's most I can see the pair rising. And we have an early week decline down to 86.60, right? So that should be the downward target in the case of a bearish move in here, but not expecting much for that particular one today.
Okay, there are comments in YouTube that say it's not event, such a rate hike that move the market, is order flow. What do you think?
Again?
It's not the event that move the market. It's the orders. Are the order flow?
Yeah, well, orders depend
on the events.
Yeah. Just I'm getting a heads up from Gerard from the office. He's telling me something about Donald Trump giving a speech today in 20 minutes.
Detroit.
20 minutes after the Fed. So beware of that.
Yeah, he's meeting
with
car makers in Detroit. I think it'll be about the auto industry. I don't think it'll be very general, but who knows with Donald Trump.
Yeah. Okay, 4 minutes to go.
Yeah, 4 minutes to go. Let me sit here.
Yeah. A rate hike will not be a surprise. A lot depends on the dot plot. We'll try to get you the information as soon as possible.
Okay, the dollar is slightly higher against its European rivals ahead of the news. The Aussie and the yen, on the other hand, are stronger. Nothing really serious so far. First, we are going to see the statement and the rate decision. And 30 minutes later, we will get the press conference, right? So
Yes.
yeah,
Yeah, we will have Jannet Yellen here talking with us.
Talking with us and with a few other people. But,
Uh-huh.
4
Okay,
minutes.
3 minutes.
Yeah.
Okay,
here we go.
dollar is up, kind of up.
Yeah.
In many US events, the best currency pair to look at is dollar yen. I mean, for the very immediate reaction, at least.
Yeah. Very good.
Yeah, Rene Fernandez in Facebook is telling us that leave you feeling outside, think coldly. Yeah,
Yeah.
and don't risk too much.
Yeah, and give the market the time enough to digest the news. Currencies will keep on moving 4 hours, 10 hours, tomorrow, next week, next month. You don't have to risk.
Yeah, the market will be there tomorrow.
Yeah. Okay, let's have 2 minutes to go.
Tick tock, tick tock. So dollar yen 114.56, 55 just before the release. Let's see how many pips it moves. 30 seconds.
It would be great if she lives right somehow.
Some
That
hikes there. Some hypes there.
That will be why.
Five, 4, 3, 2, 1.
So opening bell.
1, 2, 3. Oh. Some nice jumps here and there. Yeah, 25.
Unchanged?
No, yeah.
No,
High.
yeah, they hike a high, 25%, 25 basic points up.
Oh.
So, any news about the dot plot? Doesn't look so good. Or Fed inflation close to goal refers target as symmetric. Kashkari dissent. So we have one dissenter. Kashkari is the one from the Minnesota Fed that talked about regulating the banks.
Whoa, dollar down.
Dollar is really, really down.
So is it a dovish hike?
Yeah, I'm trying to look if we have some headlines from the statement that can be behind this.
So let's look at the statement.
I'm trying to find the statement.
Yes, there's one. Says there are more to come.
One dissenter, Neil Kashkari. 9 members see 3 hikes this year. In December, 6 members expected 3 hikes. So this looks a bit more hawkish, no?
Yeah. There are still 3 hikes on in the basket.
And the dollar undoubtedly crashed. At least dollar yen is down something like 70, 80 pips.
Yeah.
And it's across the board.
The euro dollar is breaking through the 60, so there's a good chance we can test the 700, 720 area. That's a major resistance because it's the 38.2% retracement of the post-US election decline. It's the level that has capped the upside since late January, right? And it seems that it's like a line in the sand for the market. So beware of that level because we can reach it and find some resistance in there. But if we actually end the day above it and break it, there's a good chance that the pair will keep on running. And I have my next bullish target at 820, which is the 50% retracement of the post-US election decline between November and January. Okay, so far it seems quite as we were talking about buying the rumor and selling the fact, because headlines I can take out of Twitter right now. I've seen that well, the Fed it's on track to keep tightening, right? So pretty much the 3 rate hikes were priced in already at the beginning of the year. This one was priced in and when confirmed. So not much more behind that news, right?
Pound dollar is breaking up.
Here is the dot plot. If you want to see it, not so pretty. I don't see major changes. Yeah, so Fed raised rates as expected, left projections at 3 hikes. That means 1 gone, 2 to go. The dollar is falling. 1 dissenter, Neil Kashkari from the Minnesota Fed. So quite a strong reaction. Let's see, where's the meat? It looks like a sell the rumor reaction, but because we didn't have a major change in the dot plot, but yeah. So 14 Fed officials see end 2018 at 2.1% vs 10 in December. Okay, but markets are now pricing only 1 more rate hike in September for 2017. So according to bond market, according to Fed fund futures, you see here a headline on Bloomberg, it's only 1 more hike in 2017. So contrary to the dot plot, markets are more pessimistic about Fed projections.
Yeah, but look at the Fed Watch tool. Yeah, 55% for another hike in June.
Yeah, I'm not sure it's up to date.
Probably December, the market will probably be thinking about just 1 more hike by the end of the year. Bloomberg is saying so.
Treasury surge as Fed maintains hike forecasts for 2017-2018. Yeah.
Oh, okay, Valeria. So, what are your levels to watch now in the euro dollar?
Well, as I said, the pair is breaking through 660, right? So my huge resistance now stands at 710 or so, in between 700 and 720. as if you take a look at, let me change to bigger time frames. Let's take a look at 1 week. Okay, here we are. The pair has been unable to surpass that area, right? Since over 2 months or a bit more, right? Selling interest has been strong. If you put your daily, you will see how many times the price was rejected from that area. So I'm seeing that the current area, it's been a major resistance, okay, because it also stands for the 38.2% retracement of the post-US election decline, right? So it's the market has established there sort of a line in the sun. If somehow the pair closes the day above 720, then the risk will turn clearly towards the upside, particularly if the ongoing government wins elections in the Dutch elections, I mean. So then the pair has scope to test 820, which are also some relevant highs and the 50% retracement of the post-US election decline. Those are the levels I would.
Okay, and look the cable.
Yes, 2280 is passing 2260. Also a strong resistance. The Australian dollar settled above 76. Doesn't look good for the greenback.
No, I think as we answered a question earlier, the Australian dollar was poised to take advantage of weakness of the US dollar. According to at least the data I have, it's 1.4% up, Kiwi 1.3%, and they're sort of running ahead of the others in the percentage gains for today.
Yeah, the Canadian dollar is the only one lagging because of crude weakness. It's the only currency that seems not to be that strong against the greenback, but anyway, strong against the dollar.
Yeah, so it seems that Neil Kashkari did not get the memo. He was not part of the, the hawkish chorus. He, according to the statement, he voted against the action. He preferred at this meeting to maintain the existing target range for the federal funds rate. Dovish dissenter.
Yeah. Just one.
Yeah, anyway. On the other hand, sorry.
No, go.
Now we have 14 members seeing 3 hikes in 2017, 14 members against 11 members. So you could see this is a bit slightly more hawkish, but I guess so far I can explain this by a sell-the-fact reaction.
Yeah, pretty much what happened as we were discussing earlier with the last 2 big events from the US.
Okay, we are 20 minutes from Jannet Yellen. What we can expect from Jannet today, Yohay?
Well, she'll begin with the written statement in which she'll explain why they decided to raise rates. She needs to express confidence, and there are a few supporting words in the statement, like the fact that, well, jobs growth is rising. It appears in the statement. Inflation looks to rise gradually towards the target and things like that. On the other hand, she will not pre-commit to anything. She'll probably ask if they're going to raise rates in June. She will say, we don't know it. Everything is data dependent. She'll be asked questions about fiscal policy. She'll say if there's more growth, we'll raise rates more. If not, not. Something that every boy or girl can understand quite easily. She usually likes long explanations and not saying too much substance. Well, what do you think, Valeria?
Well, I'm thinking that's pretty hard to try to anticipate whatever Yellen has to say. Give me a second, sorry. He's talking to me.
So for those joining, sorry.
No, but pretty much I agree with what you said. She will keep on the positive tone, but she's not usually a person that tends to anticipate too much. So where the only hope the Greenback has right now, if she said something about July or June being the next rate hike, opening door for 3 rate hikes, as then we will have September and December, something that will hardly happen, right? Pretty much confirming a rate hike on June, July. And pretty much I'm in wait and see mode. I'm not sure what to expect about her.
Yeah, in the past, sometimes something that she said during the press conference made big moves, especially her first press conference. But when she said considerable time, 6 months between ending QE and raising rates. But in many cases, like testimonies, she tries not to rock the boat. So
yeah, that's what I was trying to say. Thank you.
Yeah.
Sorry, got a bit distracted.
She likes answers. Well, on one hand, on the other hand, if things are better, we'll hike more. If things are worse, we'll hike less. Yeah, common sense.
Yeah, what I'm watching also is that gold prices move up to 14.15, as we were talking about. 14.16 being the first target, and it's pulling a bit back. Same's going on with the rest, pulling back a bit from the highs. Waiting for Yellen right now.
Okay, we got a question here about the euro dollar. What is your take in that moment? Euro.
Well, it pulled back from the 700 area we were mentioning earlier. We need to take 720 clearly to talk about a bullish extension, right? If not, I do believe that the market will remain within its 490, 700 range for longer. And once the central bank's dust settles, and I mean today we have Fed, tomorrow we have the Bank of Japan and Bank of England. So pretty much starting next Monday, the market will turn back to trade political, right? Political woes, either in Europe and the US, and watch what Trump says, see how elections are going, how polls in France, and so on. But to be honest, I'm thinking that we're not going to see a lot of definitions in the market until next summer. Once the batch and
this summer.
French, yeah, mid-year. French elections, German elections will be over. Trump will be well into the first 100 days, and well, supposedly the U.S. will move the bill about tax cuts to the Congress by summer, right? The Fed could or could not raise rates again, confirming or not the 3 hikes for the year. So to be honest, that's what I'm thinking. We are not going to see big trend definitions until then. That's what I'm thinking. I may be wrong. I could be wrong.
Yeah, for me, the big date is May 7th, the second round of the French presidential elections. That's when we'll know if Marine Le Pen is president. That means the beginning of the end of the euro. It has a low probability, but it's a big risk. So, and that will be around 100 days for Donald Trump. So that's when he will be judged by lots of analysts. Especially, I think for me, it's already clear that he's not focusing on tax cuts and infrastructure, but more on healthcare and on, well, a bit of trade wars. But after 100 days, things will be a bit clearer. So that's for me the big uncertainty is France. German elections, we have 2 mainstream parties, the Christian Democrats and the Social Democrats, head-to-head. So of course, markets prefer Merkel, but if it will be Martin Schulz, it's not a big difference for Europe. Maybe a bit of a difference in domestic policy, but for me, May 7th is the big date.
It's the date. Well, yeah, I was thinking on summer because in May, June, July, we will have a lot of big news that will define the destiny both of the US and the euro area. So, well, I'm a bit more conservative than you. Just a bit.
Okay, Valeria, what do you think to get back to the Australian dollar?
Yeah.
There are comments here in this time in YouTube that the Australian dollar made an inverse head and shoulder on the hourly chart. The hourly
The
chart.
1 hour chart. Give me a
Yeah,
second.
1 hour chart.
Yeah, yeah. I'm actually an inverted head and shoulders figure. Maybe that's what it's saying. The first shoulder, this being the head, and this being the second shoulder, and the neckline has been clearly broken. Yeah, indeed. Could be taken as a bottoming figure in the short term. But again, as I mentioned earlier, if you take a look at the weekly charts, you will see that the pair has had trouble to settle above 77 since early 2015, right? There have been already 2 years that the pair can break or advance beyond 77, but briefly. So that's the main bullish target in the case of further advances with Yellen, right? What I'm noticing lately is that once we get to that level, the market rush to take profits out of the table, and on dips towards 36, the market tries to buy again, or in this latest case down to 75, the market buys again. So the out also seems quite strong and quite bullish for me, right? But we're with cautious at current levels because steady gains beyond 77 are quite unlikely yet. So, as I mentioned earlier, we have an Australian employment uh, report being released during the upcoming Asian session. So take a look at that because a strong report can push the pair up to 77.40 if we close the day near 77 or so.
Okay, let's move. There is a question here. So let's move to the correlated. Well, no, the related asset, the commodities. Is what do you expect, Valeria, in gold as it hits the resistance? That is a question from Muhammad Amer.
Well, I do remember, I do believe I mentioned 1216 areas being the immediate resistance, and in fact, we saw a bit below it ahead of, after, sorry, the rate hike. So that's the level to beat a bit more beyond this high to talk about the upward extension. Then 22 seems a probable bullish target. But as I mentioned earlier, uh, a rate hike in the US, it's usually seen as dollar bearish. The risk environment is seen as gold bullish. So it's like the middle is between a rock and a hard place right now. But of course, short term bullish. Okay. 22 seems the first target on a break above 1216.
Okay, cool. Let's move to the oil. We didn't cover the oil today. What's your take on that?
Well, there's not much to say in here. Uh, it's falling. It's under pressure. It's below 50. The fact is that despite the efforts the OPEC has made to trim output and deal with lower prices and the global glut and try to push prices beyond 50, uh, in the US, things are going the other way around. The US is producing even more and more and more. But there was small, it's very small positive news coming from the US today because the AER report said that there was a drop in stockpiles in the week ending March 10, right? So that is helping the commodity to advance some, and of course, dollar weakness. But the fact is that yes, stockpiles stand at all-time highs, the levels not seen since the record began in, I don't know, in the 70s, so 1970s, I mean. So uh, uh, there's all the efforts the OPEC is putting into the oil market are being offset by US increasing production, right? Even on Friday, last Friday, we have the Baker Hughes oil field company report that showed that uh, there are we are at the highest level of drilling rigs in the US since 2015, right? So everything is suggesting the US production will keep on rising, and therefore there's little scope towards the upside in oil prices coming from the fundamental or the macroeconomic environment, right? At this point, the commodity is unable to regain 49.20 is for immediate resistance, 49.20, yes, ahead of 50, and above that, this high we have around 50.80, intraday high we have earlier this week, and at 50.90. 50, yeah, 670, sorry. That's the level I'm watching as a probable bullish target, but overall, I still see it weak, I do believe that the risk remains towards downside. This spike, it's been dollar triggered, so if we take 48 level lower again, the risk will turn towards 45, not for today, not for tomorrow, but for the upcoming days.
Yeah, we're about halfway through the OPEC non-OPEC agreement. It was signed at the end of November, and the implementation began at the beginning of the year, but it's only a 6-month agreement. So far, we know that OPEC cuts are mostly Saudi Arabia, so Saudi Arabia even cut more than they promised to do, but the other countries are not moving along that quickly, but it's all in all 90% compliance. Non-OPEC, it's Russia is going a bit slow there. We have only 60% compliance. There's uncertainty about the extension of the deal beyond these 6 months. And as Valeria said, US shale production is rising. It passed the 9 million barrels per day benchmark. Inventories, well, today they allowed for a correction, but what sparked this big sell-off was the inventory report for last week, which showed a big rise, but that was sort of the match that burnt the oil. We had all these problems already pushing oil prices lower. I mean, this was sort of waiting to happen because of uncertainty about the global balance of supply and demand.
Okay, thank you. Yohay, there some question there. If you expect to see the oil again above 60 or 70s levels?
No,
I
way.
don't. Yeah.
No. What? 60?
Yeah, neither fundamentals, neither technical levels.
Double top at 55, more or less 55.20, but also fundamentals seems like everybody wants to sell as much as possible of the black stuff, and
Yeah. 55 is a huge Chinese wall it has there. Yeah.
It depends if Chinese wall or Trump wall.
Well,
The Trump is invisible, invisible.
yeah, you have a point there. I have to agree. But
Yeah. Okay, so
sorry.
yeah, go
sorry.
ahead.
No, I was just noticing that the Swiss franc it's pretty strong, and that will probably fuel euro recovery.
That's more. Yeah, there is some people that asking about the dollar, if they will want to go long on dollar. But what
Yeah,
do you
well,
think?
I would say that this is not precisely the best moment to do so, right? We don't know what Yellen will bring, but surely if the market reacted this way to a rate hike, which of course it was already priced in, but anyway, it's a rate hike and the market reacted this way, I don't see how Yellen has the power to revert this rally. The only thing that she can say is that they are going to hike back in July, in September, and in December, right? Something like
But she will not say that.
she never says anything that straightforward.
Of course, she never. Of course, she never says that. Probably that's the only scenario where she can trigger a sharp dollar rally. That's what I'm trying to say.
Yeah, I don't think the Fed wants to trigger a dollar rally. I think, well, in part they say that the stronger dollar reflects fundamentals, which means it's a healthy rise, also pushes inflation, keeps it balanced, but they don't want the dollar to strengthen too much. It causes inflation to fall too much, and in addition, it causes problems for emerging markets if the US dollar is too high, because they have lots of dollar-denominated debt. So I think if the Fed officials now are looking at the drop in the US dollar, I think they're relatively content, relatively pleased.
Well, if you take a look at the wider picture, right, the dollar is actually wildly strong, meaning it's 6 cents away from parity against the euro. 6 cents away. The British pound when was the last time the British pound stayed close to 120, 123, right? 30 years ago. So the dollar is actually strong, right?
Oh, yeah.
And well, don't mention the Japanese yen, which was trading at 75 a couple of years ago, and now it's at 115, 14, right? So maybe commodity currencies are an exception, commodity-related currencies, Australian and Japanese yen, but the dollar is actually too strong already. And if Trump wants to make it competitive, well, the further dollar strength is not the right path.
Yeah, so yeah, the dollar is strong enough, good enough, no need for further gains. Not from the Fed's perspective, I believe. Yeah, we'll hear from Yellen in a minute, 2 minutes.
Couple of minutes, yeah.
Yeah,
We're
we're
going
ready
to.
to
Yeah, okay, great.
have. Actually,
First, she'll read the statement, and then she'll answer questions.
typical Federal Reserve music.
Yeah.
Amazing. Let's check for more questions.
Okay, mayors are, yeah, in the meantime, mayors are holding quite near their highs against the greenbacks. The pullback has been quite shallow so far, so, well, Yellen passed the last wording, but doesn't look good for the greenback.
Yeah, now we'll enter, I think, a few minutes of wait and see until we'll have a further reaction to Yellen. If she doesn't say anything new, I think there's room for more falls in the US dollar, but she can move market, of course. So,
Are we there yet? Is she coming in? Oh, she's there. Yeah, yeah. Let's
Yeah,
go.
she's here.
Good morning, ladies and gentlemen. No, that's Draghi.
Good afternoon. Today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 3/4 to 1%. Our decision to make another gradual reduction in the amount of policy accommodation reflects the economy's continued progress toward the employment and price stability objectives assigned to us by law. For some time, the committee has judged that if economic conditions evolved as anticipated, gradual increases in the federal funds rate would likely be appropriate to achieve and maintain our objectives. Today's decision is in line with that view and does not represent a reassessment of the economic outlook or of the appropriate course for monetary policy. I'll have more to say about monetary policy shortly, but first I'll review recent economic developments in the outlook. The economy continues to expand at a moderate pace. Solid income gains and relatively high levels of consumer sentiment and wealth have supported household spending growth. Business investment, which was soft for much of last year, has firmed somewhat, and business sentiment is at favorable levels. Overall, we continue to expect that the economy will expand at a moderate pace over the next few years. Averaged about 200,000 per month over the past 3 months, maintaining the solid pace we have seen over the past year. The unemployment rate was 4.7% in February, near its recent low. Broader measures of labor market underutilization also remain low. Participation in the labor force has been little changed on net for about 3 years. Given the underlying downward trend in participation, stemming largely from the aging of the U.S. population, a relatively steady participation rate is a further sign of improving conditions in the labor market. Looking ahead, we expect that job conditions will strengthen somewhat further. Turning to inflation, the 12-month change in the price index for personal consumption expenditures rose to nearly 2% in January, up from less than 1% last summer. That rise was largely driven by energy prices, which have been increasing recently after earlier declines. Core inflation, which excludes volatile energy and food prices and tends to be a better indicator of future inflation, has been little changed in recent months at about 1.75%. We expect core inflation to move up and overall inflation to stabilize around 2% over the next couple of years, in line with our longer run objective. Let me now turn to the economic projections that were submitted for this meeting by committee participants. As always, participants conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the many factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product is 2.1% this year and next, and edges down to 1.9% in 2019, slightly above its estimated longer run rate. The median projection for the unemployment rate stands at 4.5% in the fourth quarter of this year and remains at that level over the next 2 years, modestly below the median estimate of its longer run normal rate. Finally, the median inflation projection is 1.9% this year and rises to 2% in 2018 and 2019. These economic projections are very little changed from those made in December. Returning to monetary policy, the committee judged that a modest increase in the federal funds rate is appropriate in light of the economy's solid progress toward our goals of maximum employment and price stability. Even after this increase, monetary policy remains accommodative, thus supporting some further strengthening in the job market and a sustained return to 2% inflation. Today's decision also reflects our view that waiting too long to scale back some accommodation could potentially require us to raise rates rapidly sometime down the road, which in turn could risk disrupting financial markets and pushing the economy into recession. We continue to expect that the ongoing strength of the economy will warrant gradual increases in the federal funds rate to achieve and maintain our objectives. That's based on our view that the neutral nominal federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, is currently quite low by historical standards. That means that the federal funds rate does not have to rise by all that much to get to a neutral policy stance. We also expect the neutral level of the federal funds rate to rise somewhat over time, meaning that additional gradual rate hikes are likely to be appropriate over the next few years to sustain the economic expansion. Even so, the committee continues to anticipate that the longer run neutral level of the federal funds rate is still likely to remain below levels that prevailed in previous decades. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate is 1.4% at the end of this year, 2.1% at the end of next year, and 3% at the end of 2019, in line with its estimated longer run value. Compared with the projections made in December, the median path for the federal funds rate is essentially unchanged. As always, the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to their economic outlooks and views of the risks to their outlooks. Changes in economic policies, including fiscal and other policies, could potentially affect the economic outlook. Of course, it is still too early to know how these policies will unfold. Moreover, fiscal policy is only one of many factors that can influence the outlook. In making our decisions, we will continue, as always, to assess economic conditions relative to our dual mandate. As I've noted previously, policy is not on a preset course. Finally, we will continue to reinvest proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. This policy, by keeping the committee's holdings of longer-term securities at sizable levels, has helped maintain accommodative financial conditions. As a matter of prudent planning, we discussed at this meeting a number of issues related to an eventual change to our reinvestment policy. We made no decisions, and we will continue our discussion at subsequent meetings. In keeping with the principle that the process of normalizing our balance sheet will be gradual and predictable, we will provide more information about our plans as it becomes available. Thank you. I'd be happy to take your questions.
Pick you up on the last balance sheet normalization. Clearly, you said you don't want to start pulling in the size of the balance sheet until normalization is well underway. Could you give us some sort of sense about what well underway is in your mind? What kind of hurdles do you set? What kind of economic conditions would you like to see? Is it just a matter of the level of the short-term federal funds rate as being the main issue? And what kind of role do you see the role of the balance sheet playing in the normalization?
Well, the sound here is not that
yeah.
well. Yeah, it's terrible. It's coming from the Fed. Terrible. Okay, guys. So, what is your take on their text on the Jannet Yellen?
Well, as usual, she was conservative. Pretty much what we were commenting earlier, not offering much clues about what next. Saying that the policy is still accommodative, that core inflation has been little changed in recent months. And what caught my attention is that she said that something that the funds rate don't need to rise all that much, right, to get up to where the Fed considers it's a neutral level for the economy. So somehow she's been, I could say dovish. I could say dovish. Those are dovish words for me, meaning there's nothing really aggressive in her comments that suggests that the economy is picking up pace, neither that the Fed is picking up pace in rate hikes.
Yeah, key word for me is unchanged. No change in inflation, growth, and employment, and most importantly, in interest rates. No change from December. Same median 1.4 in 2017, 2.1 in 2018. And as Valeria said, we're getting close to a neutral rate. No change in the path of raising rates, and they won't rise that much. They won't rise that high. Again, I don't think it's really new, but maybe it has a bit more of an emphasis this time. And it shows us that, we got this hike out of the way, and wait and see mode, data dependent. Sorry?
Yes, you're right. It's sort of let's do it and move on. Taking out of the way, not actually convinced of what they do.
Well, look at the Australian dollar. I'm sorry, go ahead. And the gold too.
Goodbye, dollar.
Yeah.
Yeah, we're seeing a strengthening, of the trend. That means the dollar is falling even more as she begins speaking. Maybe markets were waiting for something to counter what they heard in the statement forecast, maybe something a bit more hawkish. This doesn't come. And there are many reactions to the Fed. the immediate reaction to the press conference, then the Tokyo session, the European session.
Yohay?
Yeah.
I hear you. Okay, are you there?
Okay. Okay, so there is no time now to buy the dollar.
No, I would say so.
Looks like a falling knife that you don't want to catch.
Yeah.
Okay, let's check for. For more question here.
Okay.
Okay, what about the dollar Canadian? The Canadian dollar. Valeria?
Yeah, give me a second. I don't have the chart, but if you can take it up, it would be great. The pair is falling, pressuring 33.50, if I'm not wrong, at the time being. Of course, it's all due to dollar's negative momentum. We'll probably continue sliding, okay, dragged by what we are seeing all across the market, but beware of oil prices, because if we have a bottom in oil, the dollar CAD may probably bounce a bit, okay?
Yeah, in theory, there's an inverse correlation between oil prices and the dollar. So falling dollar could push oil prices a bit higher. But we've seen that in recent months, we had a reaction to Trump and a reaction to OPEC, and they were a bit separate. In any case, now dollar CAD is just reflecting the weakness of the US dollar.
Okay. Okay, so guys, what do you think to make a wrap up, just to explain what happened today and what will happen tomorrow coming to the Bank of England meeting? Valeria, if you want to start.
Yeah, I was thinking that rather than say what happened is what didn't happen, what moved the market,
Exactly.
right? What happened is that the Fed raised rates by 25 basis points as expected. Everyone know it. Everyone had already priced this in. But while we have a statement from Yellen that was generally dovish because she didn't offer any hints about further rate hikes. And in fact, there were no big revisions to inflation or growth, as we were discussing just now. So seems like we are going to have another rate hike later this year, but the market is not convinced that we are going to get any more than maybe 2, okay? The 3 that the dot plot is promising, it's not clear for the market, and here we are with the dollar breaking lower across the board.
Yeah, your dollar about to cross 107. Yeah.
Yeah, this current weakness being a late session will probably extend an early Asian session. So it won't be the time to sell the greenback. Beware of whatever happens later today with Bank of Japan economic monetary policy meeting and Australian employment data. Those are the key events, and it's almost as big as the Fed, or particularly for those currencies, of course, during the upcoming Asian session. And tomorrow, well, we have the Bank of England, which, to be honest, I would expect to be a non-event, but who knows what happens, right? So once those 3 events are out of the way, the dollar will probably maintain a weak stance, and we will have a clearer picture of whether these trends that are warning right now could continue or not.
Okay. Thank you, Valeria and Yohay.
Yeah, Valeria said most of it, I guess, or all of it. Markets thought maybe that Fed became hawkish and they brought forward the rate hikes. So if they're doing one already in March, which is earlier than expected, maybe they wanted to do more. But now the Fed basically, the keyword for me, as Valeria said, what wasn't there. So what was there is unchanged projections about everything, including interest rates. And gradual, data-dependent, cautious Fed, and there's one dissenter, Neil Kashkari of the Minnesota Fed. So this was perhaps a bit too much for him. It's the first time he dissents, as far as I know. And yeah, and we will see further reactions in the Tokyo session and the European session. New Zealand GDP, Australian jobs report, 3 rate decisions, Japan, the UK, Switzerland, and also the Dutch elections. In an hour, the voting closes, and that will impact the euro. But in general, I think we'll see maybe some kind of a correction at some point, but then another move of US dollar sell-off, sort of 2 steps forward, 1 step backward. But basically, markets were expecting too much. Now they scaled back from 3 hikes to 2 hikes. Maybe we'll still have 3 hikes. I don't know, but I guess they were maybe the whisper number. Maybe it was 4 hikes. So sell the fact on the unchanged, on, as Valeria said, on what wasn't in the decision. Nothing really new.
Okay. Thank you. Yeah. Do you want to say something, Valeria?
No, the meeting in Jannet was a bit disappointing, but that's what's keeping the dollar under pressure, and we'll probably keep it during the coming hours.
Which currencies are set to gain more and which to lose more, do you think?
Oh, the euro, it's a key critical for me, reach the resistance area. If we move through 720 and trigger stops above that level, we have a nice way to go. The Japanese yen is stronger, so a break lower, I still see it. And the Aussie is still set strong, although I fear the 77 region and sellers around it will depend on employment data, whether the Aussie can go higher or not.
Yeah, I see the Aussie as the strongest. Maybe the pound remains the weakest. And the euro, if we have sort of a market positive outcome in the Netherlands in an hour, I think the euro is now a bit holding back, and it may sort of do some catch up. But of course, we don't know what the result is going to be. We only know that many, many people in the Netherlands came out to vote, higher turnout than in previous years. But we don't know what it means for the results. At least I don't know. I don't understand too much in Dutch politics. So.
Well, if the opposition wins, it's a populist party, right?
Yeah.
That votes to figure it out.
Now I put the euro under pressure. Yeah.
They want to limit immigration, and they want to discuss the terms of belonging into the euro area. So pretty much, it's like a Marine Le Pen.
Yeah, an exit, Netherlands exit. Yeah,
an exit.
Yeah,
it will be like a
thermometer. We need. Sorry, let me start over. I guess we need to start a bet on how longer will the euro area will live.
Yeah.
When it will be the end of the euro area, because the Brexit was not, but the Brexit indeed was the beginning of the end.
So if you're saying that if today the populists win, and then there is coming Marine Le Pen, that is the beginning of the end of the euro area.
I believe that it already started with the Brexit, but well, that's me.
Yeah, but for today, if a Freedom Party of Geert Wilders comes out first, doesn't mean they'll be in government, but it'll give a boost to Marine Le Pen, and it will, I think, push the euro a bit lower. But if, as the polls show, Mark Rutte's party will win, the center-right Liberals, I think it will allow the euro to do some catch-up with the Australian dollar, for example, and gain a bit more against the US dollar, and maybe it'll push Marine Le Pen a bit back. But France is not. It's not only influenced by the Netherlands. It's only a small indicator in the bigger scheme of things.
Yeah, but also the election, there is Fillon that is getting some dirty campaign. Marine Le Pen is getting more and more, popular. It's getting more popular because the others are not that good. It's like something that happened before with Trump.
Yeah, but the leading candidate there is the centrist former socialist Emmanuel Macron, and at least in the second round, he leads 60 to 40%, which is a much bigger gap than the opinion polls about the US elections and the EU referendum in the UK. So,
well, that happened before. with the fathers of Marine Le Pen. Do you remember the previous election when the Le Pen, the father,
Yeah.
was in the second round.
Yeah, but there he lost with the 60% difference. It was 80%. But who knows? History doesn't always repeat itself. So.
Yeah. Okay, guys. So I think we can wrap up the coverage. So see you tomorrow. It will be less than 24 hours from now. See you tomorrow for the Bank of England coverage. And anything else that you want to say?
No. See you tomorrow.
Thank you. Yeah.
Bye-bye.
Okay.
Beware of
Thank
Bank
you,
of
Valeria.
Japan Australian employment.
Oh yeah, remember the Bank of Japan.
Yeah.
It's coming a couple of hours. Okay, guys. Thank you, Yohay. Thank you, Valeria, and thank you everybody that came today. It has been a pleasure to share that Jannet Yellen and Federal Reserve interest rate coverage with you guys. See you. Peace.
Thank you. Bye-bye. Nice to
Thank
see
you.
you.
Bye-bye.